Today we are covering net operating losses, or NOLs, specifically the rules you must know for the enrolled agent exam. The Tax Cuts and Jobs Act, or TCJA, fundamentally changed how NOLs work, and the exam will absolutely test you on these new provisions, especially for any loss arising after 2020. The most critical rule to master is the income limitation. An NOL deduction is now limited to 80% of taxable income, calculated before the NOL deduction itself. Expect a scenario question like this. A client has taxable income of $200,000 before any NOL deduction, and an NOL carryforward of $500,000 from a prior year. The exam will ask for the deductible amount in the current year. It is not $200,000. The deductible amount is limited to 80% of $200,000, which is $160,000. The client's taxable income is reduced to $40,000, and the remaining $340,000 of the NOL is carried forward to the next year. The most common trap here is forgetting this 80% rule and allowing the NOL to wipe out taxable income entirely. Next, let's focus on carryback and carryforward periods. For NOLs generated in tax years after 2020, the 2-year carryback is gone. Instead, these losses can be carried forward indefinitely. This is a major shift from the old rules. The exam loves to test exceptions, and the main one here involves farming losses. A loss from a farming business can still be carried back 2 years. A question might give you an NOL and ask about the carryback potential. The first thing you should do is check the source of the loss. If it's not from a farming business, there is no carryback. Don't get tricked by old information about a 5-year carryback, which was a temporary rule under the CARES Act for 2018 to 2020 losses. The exam focuses on the permanent rules. Calculating the NOL itself is another area ripe for exam questions. An NOL is not simply the negative number on the bottom of Form 1040. You must make several modifications. Crucially, an individual's NOL is generally limited to business losses. Non-business deductions, like the standard deduction, can only be used to offset non-business income. They cannot create or increase an NOL. For example, if a taxpayer has a business loss of $30,000 and takes a standard deduction of $13,850 with no other income, their NOL is $30,000, not $43,850. The standard deduction does not add to the NOL. Similarly, capital losses can only offset capital gains when computing the NOL. You cannot deduct the extra $3,000 of capital losses against ordinary income for the NOL calculation. For a quick memory aid, remember the phrase 80 forward forever. This helps you recall the key post-TCJA rules. 80 for the 80% taxable income limitation. Forward forever for the indefinite carryforward period with no carryback. Finally, a quick word on forms. While you might see Form 1045, Application for Tentative Refund, mentioned, its use is now limited mostly to those rare situations where a carryback is permitted, like for farming losses. For the vast majority of clients who are carrying an NOL forward, you simply report the NOL deduction on their Form 1040 and track the remaining carryforward amount on a separate worksheet in your records for use in future years. The exam is less likely to ask about the mechanics of filling out the form and more likely to test whether you know when it is appropriate to use it versus simply carrying the loss forward on the annual tax return.